What's up, ladies and gentlemen? So the next question is, in our last video, we talked about buying calls and puts and just the very basics of it. So in this one, we're actually going to explore some of the basics of selling calls and puts. Selling to open. This is not once you bought it, here's how you sell and close it. This is sell to open the position. I almost jumped into it, but I didn't want to get carried away and give too much information out in one video. But this is when you are the writer of the contract. So again, selling to open. So to define what it means to sell an option. So when you sell an option, you're creating the obligation to buy or sell a stock at a predetermined price within a specific time frame. So just like with buying the options, there are two main types, calls and puts. So when you sell a call option, you're selling the right for someone else to buy a stock from you at a specific price, again, known as the strike price and the expiration date. And let me turn to this. So last time we had Palantir. Okay, so talking about the let's go with I forget which position we used. Okay, so for instance, let's say we own 100 shares of Palantir because each contract is for 100 shares. So when you're looking at these prices over here, it's not actually 71 cents. It's 71 cents per share. So that's $71. 71 cents times 100. So again, you're selling the right for someone else to buy the stock from you at whatever price you determine, as in your strike price, and then the date, again, your expiration date that you pick from. Now, this is what's called a covered call because you own the shares. Selling a naked call is when you don't have the shares, and all you do is sell the contract to open it. It's not something I would ever recommend anybody to do. It's one of the very few things where your losses are unlimited. And this is what happened. If you guys remember GameStop in 2021, if you sold somebody the contract, you sold, let's say it's $4.50, and you didn't have the shares, but you sold somebody the $5 strike call and it goes to $350. You have to go out to the market, buy 100 shares at $350, and then sell it to the person for $5 because you are fulfilling the contract that you guys agreed on. But if you had the shares, you already have the 100 shares, he buys them from you at $5. So essentially, if you bought those contracts at $4 and sold them at $5, you still made $100. All you did was leave the rest of the money on the table, and it's just not likely your stock goes to $350. We'll get to the risks here in a little bit. So just another example, again, so Palantir, here's a very realistic one. Let's say you bought it right now. You bought 100 shares at $23.84. That would 100 shares is going to cost you $2,384. So you'd think, okay, I want to go ahead and sell a call option against it. You want to collect some money. You've heard about that. There's multiple strategies we'll get into. A very popular one, covered call, goes into like the wheel strategy. The expected move up here, something I go over on my YouTube streams a lot. It's $1.22. So we'll just say $25 puts us right outside the expected move. You could sell this contract. Now, the premium, 17 cents per share, so $17. Someone would pay you for the right to buy your shares at $25. So right now, if Palantir by the 28th expires below 25, you'll just keep this guy's money because why in the world would they buy your shares at $25 a share when they could just go to the open market and buy it at 24 or whatever price below? So when that transaction happens, they actually give you the money up front, and you'll see as things go on, the contracts do go up and down. You'll see your P&L reflect that, but as it stays level or down, you'll see that contract gets worth less and less, which is positive for you. So on the other hand, when you're selling a put option, you're selling the right for someone else to sell a stock to you at a specific price, an expiration date. So the strike and expiration date. And if you guys haven't figured this out, essentially what you're doing with selling calls and puts is getting paid to put a limit order out there. A lot of times when people want to buy a stock, let's say I want to buy Palantir, but I'm going to put a limit order out there for $23. And when it goes to 23, it will fill. And I put a sell order. That's my take profit on Palantir at 25. I could sell a call and get paid to do that, provided it's not just that day, but at expiration. Okay, so selling a put is again the right for someone else to sell you a stock. Sorry, I'm trying to think of the very specific way. I want to make these as simple as possible. Anyway, they're going to sell you the stock at this price. So again, a very simple strategy. So we're going to go $1.22. So that's what we'll call it the 2250s. So right here again, you might not want the shares. You might just let fate decide. So you sell the 2250. You collect the $11, 11 cents per share times 100. And if it goes below, you will buy 100 shares at 2250. And again, we'll get into the wheel strategy. That's how a lot of people get paid for things they want. Getting paid to put a limit order out there. So some key points. So selling a call option obligates you to sell a stock at that price and expiration you pick. Selling a put option obligates you to buy that stock at that price. The strike price is the price at which you must sell or buy the stock if that is exercised. The expiration date, you guys know that, is the last day the option can be exercised. A lot of deep in the money stuff. The Options Clearing Corp will go ahead and exercise. That's early assignment. Everybody loves to ask, when does that happen? The Options Clearing Corp does not have any rules. They will simply just, I hate to say it, draw a line and say, hey, anything above or below that, assign it. Get it off the books. The premium, again, is the income you receive for selling the option. So that number we talked about right here, how much they paid you up front for that. Now, the important part, we touched on a little bit earlier, the risks. When you sell a call or put option, your maximum profit is the premium you received. Again, they paid you on that call $17. So should the stock price, the underlying, stay underneath your strike on that call, your 100% is what you collected. You just get to keep it all. However, the potential losses are very different. If the stock price moves significantly against your position, you might face substantial losses. And that's some fancy internet wording you got there. And that's what I mean. If you do not have the shares, honestly, I would not sell a call unless you have the shares already. It's not ever worth the risk. You just don't know in this day and age when that tweet happens, when that report comes out, something happens. Pelosi buys it and sends this thing to the absolute moon, and you're in a call. You got to go to the open market and buy shares at that price. It's not going to be pretty. That's how you end up with an invoice, not just a blown account. So don't. As far as selling a put, like let's say you want to sell the 20 strike on Palantir, it's actually going to lock up $2,000 out of your account. So your worst case scenario is that goes to zero and you lose out. You bought your shares at $20 and then the stock went to zero. That is your ultimate risk on that. Anything else? Okay, selling a call means you're betting the stock will stay. Yeah, selling a call, you're betting the stock will stay below the strike price. Again, while selling a put, you want it to stay above the strike price. I always get those backwards, and I know why a lot of other people do. Because when you are a seller, everything you've ever been taught and heard about is about buy to open, sell to close. A lot of people don't short the market, and it gets very confusing when all of a sudden you're just backwards. But selling options generates a lot of income for me. It's one of the more consistent ways to generate income. But I can't stress it enough. The risks when selling a call without the shares is astronomical. And it's a reason why level 4, the highest level you can get as far as options trading, the very last level is just selling naked calls by itself. Most people watching this video won't have the money for that. And that's not a dig, but it takes a significant amount of capital for you to even get access to that. So most of the time you'll be talking about a covered call. Covered meaning you have 100 shares and you sell one call. That's covered. Naked being all by itself. Okay. These questions are tough to not rant and go on, but let me know how I'm doing as far as answering these questions go. Again, let me know all your stock questions because everything now, all the questions, they're all just going in video format. Obviously, when I announced this, a bunch of options questions came in. So we're going to be covering a lot of options right now. But again, hit me with the questions in the comments down below. And I guess just check the next video. You got to turn the notification bell on, get notified for the next one. You will see that blue and black thumbnail. All the questions will be answered in that format. Anyway, have a good one.